Welcome to Key Points for May. This month, our take on continued higher interest rate expectations, why we think China is running out of time for additional stimulus, and our views around the rout in equity markets that we've seen and what the future holds from here. Now, turning to the first point, higher inflation prints are now emboldening central banks to be much more hawkish in terms of their policy initiatives. In the United States, inflation has moved higher, although the core PCE measure did tick down last month. The headline at 6.6% is a concern. And perhaps more worrying is a notable pickup in the employment cost index in the first quarter, showing that inflation is seeping into wage negotiations. Now, in terms of Europe, the ECB again is also much more hawkish in terms of their view. Only a few months ago, it appeared that rates were going to be on hold throughout the course of this year and well into next year. Well, that's clearly now changed. The ECB has stepped up the pace of tapering asset purchases, and this is really setting the stage for a potential first rate hike as soon as July of this year. While we're a little concerned about this quite dramatic shift, there's no doubt about it that the higher inflation numbers are forcing these central banks to show that their inflation targets are still very much being honoured. Now, in terms of the United States, although the Fed is going to move, we think, by 50 basis points at this coming May meeting and an additional 50 basis points in June, we still believe that a cautious approach will be required thereafter. The economy will be slowing and there are still inherent vulnerabilities within the system. And frankly, financial conditions globally, but also in the United States, have tightened appreciably in recent months. So much so that, for example, US mortgages are now at the highest level since 2008. So this will have an impact in terms of purchasing power and in terms of just the growth dynamic. Now, speaking about growth, we turn to our second point, which is around China, because growth is clearly showing really worrying signs because of the additional lockdowns that are being imposed. Many regions are seeing these. Shanghai, of course, is also under lockdown currently, and this will impact global supply chains. They had been recovering very nicely, but this will put a bit of a spanner in the works in terms of that going forward. But the domestic economy, more importantly, is also being impacted. The latest April readings for services and manufacturing PMI survey data show a real marked slowdown in April. So again, something to be concerned about. Now, this is important because, of course, we have the National Congress at the end of this year. And of course, we had a commitment that growth in China would be around 5.5% this year. As a result of that, we do believe there will be quite significant stimulus applied, additional infrastructure coming through. And while we would like to see that broaden out also to impact demand to improve that, the likelihood is that this will put a floor under the growth that we've been seeing and likely to lead to quite a marked pickup in the second half of this year, which frankly should also help Chinese financial markets, which have been under considerable pressure. Now, when we look at financial markets more broadly, we have seen quite a marked tick down. Investors have succumbed to these higher interest rates and higher inflation dynamics, even though in recent months they had been prepared to look through the atrocities of the war in Europe. Now, given the pullbacks that we've seen, for example, the tech-heavy NASDAQ index in the United States is down 23% from its November highs. This marks what was often known as a bear market. Markets that are down more than 20% are generally referred to as being in bear market territory. And that clearly now is the case with the US NASDAQ index. The S&P 500 is held in better. More broadly, globally, stocks are not so bad, but clearly they've been under selling pressure, quite persistent selling pressure in recent weeks. Mutual fund data imply that we've had outflows from equities, and when we look at some of the US sentiment readings, we're now at multi-decade lows. Now, while we think it will be some time before we get a sustainable improvement in terms of momentum, probably requiring real evidence that inflation has indeed peaked or that interest rates are likely to be on a more gradual path going forward, we think a lot of the bad news is now priced into the market. Earnings are still looking good. Margins are being maintained as companies take actions to mitigate some of the higher prices they're seeing. We're expecting higher stock buybacks and dividends continue to move a little bit higher as well. So as we look out, the fundamental dynamics, while not without challenges, is looking reasonable given the pullback that we've seen in equities so far. So we do think there's a bit of upside ahead, but again, as we've said all through this year, volatility should be expected. Remember, as always, the full report can be read on zurich.com/MSME.